Welcome to Another Round, a podcast by the Pacific Research Institute. I'm your host, Rowena Itchon. Since 2000, the U.S. economy has had an average annual growth rate of just 2%. Compare that to the 80s and 90s, where the economy grew at a 3.5% clip. Many economists believe that this sluggish growth rate is now the new normal. What accounts for this? Some say it's due to the U.S.'s aging population. Others think that we're at the late stage of the technology cycle, and still others believe that we're still suffering from the after effects of the Great Recession. PRI Senior Fellow in Business and Economics, Wayne Winegarden, believes the blame lies squarely with the U.S. government. In his new 4-part series, Beyond the New Normal, he discusses the economic policies that got us here, as well as how we can break out of these stagnant growth rates to achieve a more prosperous economy. In this episode, Tim Anaya, PRI's Director of Communications, and I sat down with Wayne to discuss the study, the current economy, the state of tax reform in Washington, and of course, his favorite cocktail. Welcome to another round, Wayne. The economy has been stuck at about 1.8% annual growth rate since 2000, and many have argued that now that this is the new normal. But last quarter, we saw a jump in the GDP about 2.6%. Do you think this is an anomaly, or can Trump really take credit for this?
Well, thanks for having me here today. I think you need to be careful about any one quarter, right? Numbers are volatile. They go up, they go down. So you really want to focus on the underlying trends. It's too early to know. Certainly 2.6% compared to what we've been doing is positive. So that's always, welcome the good news. So it's not as good as we have been historically, but we'll take it compared to the recent past. And certainly addressing the regulatory onslaught and stopping that was the most important positive so far that the administration has done. But they have done some negatives, right? Their rhetoric on trade is wrong. International trade improves our standard of living. It improves the growth rate of our economy. Immigration is good. So, that's a negative. And so we'd like to see those types of negatives stop and then see positive movement on tax reform, see positive movement on what the Fed's going to do. And with that, we could really begin to see a breakout from this kind of 1 to 2% sluggish growth we've been stuck in since about 2000.
So, Wayne, one would think that 2 decades of poor growth can't be easily reversed. Now, you've written a new 4-part study released by PRI called Beyond the New Normal, and our listeners can download a copy of your study at our website at pacificresearch.org. So, in your study, what do you conclude are the leading causes of poor growth rates in the U.S.?
The leading causes, without a doubt, are the policies that the central bank or Federal Reserve has been implementing, the higher tax rates, the higher spending, and as well as the higher regulatory burden. A lot of that happened under the Obama administration. Some of that happened under President Bush, and we haven't seen satisfactory growth rates for years. And so we can get it back. Some policies will respond faster than others. Monetary policy, what the Federal Reserve does, that tends to be a bit slower in its actions. A tax reform could be a quick boost. And what we really need is kind of a combination of policies that moves us to a pro-growth stance. Tax policy that doesn't disincent entrepreneurship, regulations that don't overburden businesses, more international trade, central bank, the Federal Reserve, stop distorting our capital markets and allow the capital to flow where it's most efficient. If we bring back these policies, we can get growth. And the perfect example is the transition from the 1970s when we had the Nixon, the Ford, and the Carter economy, and what happened and how quickly that happened under Reagan once we started getting that policy environment right. And that's part of what we looked at in the study.
So Wayne, if you were king for a day, what one policy change based on your recommendations from Beyond the New Normal would have the biggest impact on incentivizing the economy and economic growth?
It's really hard to pick one because we've got so many needs. But if you're going to force me to choose just one, I think what I would choose is Dr. Laffer's came up with I think one of the most elegant flat tax proposals. And I think that would be my choice. We have a flat income tax and a flat value-added tax. That would be in lieu of every other tax that we have at the federal level. So we would get rid of the corporate income tax, we'd get rid of the personal income tax, we'd get rid of the death tax, we'd get rid of the capital gains taxes, and we would just have these 2 simple flat tax rates. And one criticism that often pops up when people talk about the VAT is that it's hidden. And so I would address that by tying the VAT rate to the personal income income tax rate. So that if those rates have to be equal, then politicians can't hide tax increases by raising the VAT where people wouldn't see it. So if I had only one that I could do, I think that would be it.
I think your pet agrees with you, Wayne.
Yes, I think it does too. Sorry about that.
So, Wayne, as you know, the debate over tax reform is heating up in Washington. And, longtime observers like you know that this is easier said than done to have a major overhaul of our tax system. So what do you think are the prospects for Congress and the White House to actually agree this year on major tax reform legislation? And as part of tax reform, if you had to prioritize, what do you think would have the most impact? Lowering corporate taxes or lowering personal taxes?
The second part of that question, I think, is interrelated with the first. So, how do we get tax reform passed? It's a very, very tough issue because there's so many different special interests and so many different priorities. And so you have to, how do we build up that coalition? And obviously that's the tough part. And I think so in the second question, what's more important, corporate income taxes or personal income tax reform? And I think corporate income tax reform, not only would it have a very meaningful impact because of how uncompetitive our corporate income tax system is relative to Europe, relative to Japan, South Korea, especially places like Ireland, where we tax global income at basically 40%. They tax income only earned in Ireland at 12.5% or 20% or whatever the rates are in these different countries. Our rate is very uncompetitive. And so that in itself can become a unifying factor. And then you also get away from some of these tired debates. And most Democrats would agree that corporate income tax reform is something that's necessary because we are so uncompetitive. And then the other advantage I see from corporate income tax reform from a pragmatic perspective, and Steve Moore in his past podcast talked about this too, that we have $2 trillion sitting overseas that could be repatriated if we had, as part of that corporate income tax reform, some sort of tax holiday or tax rebate where they could come in at a lower rate. And that helps pay for the tax reform, quote unquote, in terms of the budgetary rules of Washington, D.C. So I think there's a lot of pragmatic reasons why corporate income tax reform, it could be a unifying, bipartisan approach that would be economically beneficial, improve the incentives, take away the incentive for all these corporations to start reforming in other countries, and that would be a great boost to the economy.
Wayne, many economists have argued that our current growth in the stock market is largely based on the expectation that tax reform will be enacted. What do you think the impact would be on America's economy if Congress and the White House ultimately fail to agree on tax reform this year?
Yeah, it would be very bearish for the economy. It would be very bearish for the market. Absolutely. I wouldn't venture to guess to say what percentage of the current valuation is expectations of tax reform, but I think it is clear that there's definitely a significant portion of kind of the valuation is based on that. And so if tax reform is not going to happen, you're going to see the stock markets fall. You're also going to see sentiment and business sentiment drop. Investment will then drop, and you're going to get a negative cycle. So there's a lot to fear if tax reform doesn't occur. That's going to be a very negative sign for the economy, and not simply because tax reform is not going to happen, but I think given the up to now failure of the repeal of the Affordable Care Act, I think failure of tax reform would send a signal that despite Republican control in D.C., that we're not going to get pro-growth tax policies. And I think that signal itself would be very bearish and a very large negative for the economy. So I don't think you can underestimate the concerns for the economy if tax reform doesn't happen.
Wayne, you recently wrote a piece for PRI's new Right by the Bay blog, and our listeners can read it at pacificresearch.org. And your argument was that Congress must be careful to avoid the unintended consequences of tax reform. What do you mean by that, and what proposals do you think Congress should steer clear of as it's overhauling the nation's tax system?
I think one of the greatest examples of kind of the unintended consequences of taxes is the consequences of capital gains taxes. I'm going to go out on a limb, and I'm going to say most advocates of capital gains taxes, their intention is not to lower wage growth for workers. Maybe I'm wrong, but I don't think that's what their intention is. However, when you have high capital gains taxes, that's exactly what the effect is. And there's many economic studies that have gone out that have looked at it that have found high corporate income taxes, high capital gains taxes, that even though it's the investor or the company company that physically pays the tax, the economic consequences falls on workers due to lower productivity, which is lower wage growth, which is part of the stagnating incomes and part of the reason we've seen these stagnating incomes for the past decade and a half. So that's an unintended consequence. The capital gains tax is not supposed to harm workers. It's supposed to be a way to raise taxes from people with higher wealth. But there you have it. That's an unintended consequence from tax reform. And so those types of proposals, or I should say complex proposals, I think is a better way of putting it. The greater the complexity of the taxes that are implemented, the more likely you're going to have these unintended consequences. Because as you get a more complex tax system, the incentives become kind of more diluted. There's ways to game the system. So when you have more of those opportunities, the unintended consequences are going to be greater and greater. And so staying away from those types of complexities is such an important part of tax reform. Simplification, simple, flat taxes. That's the way to move towards.
You know, Wayne, while we're hearing a lot about tax reform in the news, no one is really talking about spending cuts. The administration proposed a budget earlier this year, but it looks like it's dead on arrival. In Beyond the New Normal, in your study, you suggest reviewing all the government programs and evaluating them based on their value added to the economy. Can you talk a little bit about that concept and give some examples?
Oh, absolutely. This is, I think, such an important concept. We're so used to thinking about the economy, economic growth as GDP, right? It's a common measure. And of course, GDP is a private consumption, a private investment, but it's also government spending. And there's a distinct difference between government spending and what that represents and consumption. So when I go out, if I buy a car, we know that I valued that car, and I valued that car more than the amount of money it took for me to buy it. And from the person selling it, it was the exact opposite, right? They wanted the money and they had the car. So this is what economists call value added. And this is what economic growth is, the essence of it. We get more value for the same amount of money or for less money. Government spending, we don't have that knowledge. All we know is how much money the government spent. So if you have the government and let's say we're looking at education expenditures, right? We know how much we spend on education, but how much value are we getting from each additional dollar? Is each dollar improving the education outcome? And, if you look at Lance's, new study, you can see that there's, I think, very good arguments that, in fact, more education spending we're putting out there is actually destructive to the economy. And so when we start kind of trying to measure the economy, that becomes very important. And kind of the application, I think you'll go back to kind of the Great Recession. And we had Obama's stimulus program, and all the economists were telling us that all of this extra spending is going to improve the economy. And in fact, all it was doing was taking resources from higher valued uses in the private sector, spending them on low valued projects in the government sector, and destroying wealth in the process. That's not increasing the economy. And so we need to be aware of this. And also, I think Milton Friedman's dictum, right? Government spending is government taxation. So taking all of those issues into account, we really need to rethink when we're talking about GDP, what's driving it? Is it actual value, private sector, or is it just the costs of government?
Wayne, one of the tax reform ideas that would have a very negative impact on California and New York and others is a proposal that would eliminate the deductibility of state property and income taxes. Do you think this is a good idea, and why? And also, what are some other tax reform ideas on the table that would hurt states like California if enacted, and what are some ideas that might benefit Californians if enacted?
Well, absolutely. The taxes, state and local taxes, should not be deductible from the federal perspective. Californians who have very high tax states, if you're able to reduce your federal tax burden because of that, then given that those revenues, if there's a certain set expenditure level, which isn't unreasonable to assume, then residents of other states have to make up that difference. And so what effectively you're doing by allowing tax deductibility is you're taking the tax burden, federal tax burden, off of Californians and off of New Yorkers, and you're putting it on Floridians and you're putting it on Texans. And there's a certain unfairness to that. And it's really not justifiable. If Californians or New Yorkers want to have a high tax burden, they should have to pay those costs. And if New Yorkers and Floridians want a low tax burden, well, they shouldn't have to pay a higher federal tax burden because of that. So absolutely, state and local taxes shouldn't be deductible off of the federal, somebody's federal tax burden. In terms of other proposals that could benefit benefit California. I mean, one thing we have to remember, I mean, California is the largest state. It's the seventh largest economy in the world. It's interconnected globally. And so a flat tax, if we did a flat tax for the U.S. that lifted U.S. growth, California would disproportionately benefit from that. The same thing from trade deals. If we were to re-enter TPP, which I know isn't under discussion but should be, that would have outsized benefit on California, and that would effectively lower tariffs, which is a tax. So those types of benefits, because of California's position, especially in terms of trade with Asia, that would go a long way to helping improve California's economy and help bring prosperity to California.
Wayne, PRI and the R Street Institute recently released a study showing that one of the proposals that was being considered as part of tax reform, a border adjustment tax, would significantly increase the insurance costs of Californians. I know you wrote a couple of op-ed pieces on that with one of the study's co-authors, Lars Powell. Now, in a policy victory for PRI and for R Street and for Wayne, the proposal has been dropped. So could you please talk a little bit about the findings of this study and why border adjustment tax would be a bad idea?
Oh, absolutely. Lars and his co-authors, they just did a brilliant job on this study. And it's really important, too. It kind of gets back to some of the themes we were talking about earlier, about the interconnectedness of the global economy, about tax complexity and unintended consequences of taxes. And that's really kind of where this came from, that if you have a global supply chain, right, and you have a complicated economy, we don't know what's going to happen when you have a proposal like this border adjustment tax, which is basically trying to tax imports and is trying to have exports go as tax-free. So that, by the way, comes from this concept that international trade is a zero-sum game, which is not true. International trade is incredibly important to promoting economic growth. And this BAT, what it would have done is, if you had an import that was part of your production structure, right? You're a manufacturer and you import some of your goods to when you're producing, that would increase your costs. Well, in California, and I'm sure some of the listeners are certainly aware of all of the natural disasters that it's prone to, earthquakes, fires. So home insurance and property insurance is incredibly important. Well, one of the inputs to production of insurance is reinsurance, right? It's a way that insurers can manage their risks. And what this BAT effectively did is it increased the cost of reinsurance, which would have increased the cost of insurance, fire insurance, earthquake insurance for Californians, and it could have made it prohibitively expensive. That would have been a disaster for California. So thank God that proposal has been pulled. And again, it just showcases the dangers of unintended consequences from complicated tax schemes.
Finally, Wayne, if we get corporate tax rates down, if Washington repeals and replaces Obamacare and manage to roll back some of these regulations and red tape, do you see us breaking out of the 1 to 2% growth rate over the next few years?
Absolutely. With the right policy environment, there's absolutely no reason why the U.S. can't grow at its post-World War II historical average. I mean, there's nothing fundamentally different. We have new technologies, we have all this productivity, greater education. We have, unlike many European economies, we have a growing population, so a growing labor supply. There's so many positives about the U.S. economy. Look at all the oil and natural gas reserves we have, our human ingenuity. If we establish a pro-growth policy where we have free trade, sound money, regulations that address kind of the issue they're meant to address and are no more burdensome, and we have tax and expenditure policies with a flat tax and spending focusing on value-added government services, there's no limit to what the American economy can do. And that should be a positive message. If we get the right policy reforms, the economy can grow gangbusters like it did in the 80s, like it did in the 90s, like it did in the 1960s. And I think that's a positive message that we need to keep going forward as we're looking at these policy debates.
So, Wayne, the name of our podcast, of course, is Another Round with PRI, and we call it that because the wine country is so close to PRI's offices, and so many of us at PRI enjoy a good glass of wine. So we always ask our guests to share with our listeners your recommendation for either your favorite wine or favorite beer or favorite cocktail. We'd love to get your adult beverage recommendation.
I don't think I'm very interesting on this front, but For me, I'm a simple guy when it comes to adult beverages, and kind of a nice Scotch single malt. That's basically all I need and what I would recommend.
Is there a certain kind of Scotch that you enjoy that our listeners should check out?
I wish I were that discerning. No.
Single malt is pretty discerning, in my opinion.
Well, thank you, Wayne.
Thank you very much for having me.
Thanks to our guest, Wayne Winegarden, and of course, my colleague, Tim Anaya. To download a copy of Beyond the New Normal, go to our brand new website at pacificresearch.org and mark your calendars for PRI's annual gala dinner on November 1st, 2017. Our keynote speaker is Silicon Valley entrepreneur Peter Thiel. And if you like this episode, please tell your friends and subscribe to Another Round with PRI in iTunes, Google Play, Stitcher, or TuneIn. And do us a favor and leave us positive feedback and give us 5 stars. You can also listen to our podcast at PRI's YouTube page, youtube.com/Pacific Research 1. That's the number 1. Thanks again for listening. Until next time, I'm Rowena Itchon. We hope you'll come back again for another round with PRI.